Hi everyone, welcome again to Stocks for All 17. So today I want to discuss how the stock market prices move and the impact of the stock market price on the companies as well as on investors like you and I. Okay, in the previous video I have explained how the stock market works. Today, let us learn how the prices move and the benefits and the demerits of those price movements. First, what are the factors affecting the stock prices? Okay, sometimes stock prices go up, okay, when their demand is high, and stock prices go down when their supply is more. And suppose the company performs very well, the stock market prices go up in most times. And suppose there is a bad news, let's say ED department has read on that company, then because of the bad news, the stock market goes down. Or there are so many other factors like inflation, or if the GDP growth is not as expected, so it lets the market price go down of the companies. And sometimes it's because of negative emotion in the market. So let's say during COVID year, everybody thought the market is over, now the world is going to be over, so stock market crashed. And there are certain policies of the government or global events that affect the stock prices. Okay, so there may be other factors also, but they are mostly classified in these factors, okay, that affect the price of the stocks. So what does the investor benefit if the stock prices move up? Let's say back in 2005, the price of one Hindustan Unilever HUL price in 2005 was 100. Okay, now it's more than 2000. So suppose you invested 1 lakh in 2005. Now you'll get 1000 shares. Now that 1000 shares, now if you have been holding till today 2025, it will be worth 21 lakhs. Okay, so your portfolio value will increase. Now one benefit is that higher portfolio. And plus during this time, if the company gives dividends now, so HUL they give dividend every year, so you'll be getting those dividends also. Plus suppose there's a split in the company now, sometimes company prices go up, so to make it affordable they used to split the company shares. Okay, so those time if you have the shares in the company, they used to give you bonus shares now. So there are so many benefits if the prices of the stock goes up for the investors. Okay, and what does the company gain if the prices go up? So they have advantage over other companies, they can get capital more easily by sharing their equity shares. Okay, or one good thing is they get good reputation also, like Infosys. Now they have a very good reputation, that's why they get to attract the best minds in India. So they attract top talents. So, and another advantage is that they can acquire other companies at a relatively very low price or valuation. And on the flip side, the demerits of the stock prices falling for investors is your capital will fall. You lose your capital. So one classic example is Reliance. Okay, Reliance Communication. So before Jio or Airtel came, Reliance Communication was there. Reliance. So what happened was that Reliance ka one share price was 800 rupees in 2008. Okay, and when, because they could not perform well, the stock price crashed, and in 2009 it was only 5 rupees, so it went bankrupt. Okay, we all know that the Reliance Communications, they went bankrupt, that Anil Ambani. So, and his elder brother Mukesh Ambani, Jio, they succeeded. So the price fell down, so many investors lost their wealth. That is why it's very important to check the fundamentals and the financials of the company before investing. What was wrong with Anil Ambani's Reliance Communication was just they took too much debt. They took too much debt that they were not able to recover those debt, and their profit was not growing much, so they crashed. Okay, that's why it's very important to study the company. If it has too much debt levels, it's better not to invest in those companies. Okay, and yes, once stock price start going down, so many people will sell the stocks at a very cheap price. Panic selling. The classic example, during COVID, so many people sold their shares and left the stock market, okay, never to come back. So that should not happen. We should make informed decisions. We should study stocks properly before investing, and even if it falls 20%, 30%, 40%, 50%, we should hold on to good stocks. And for companies, the demerit is that once you lose your reputation, there's nothing to gain. So in his letters to all his managing directors, managers, this Warren Buffett, he used to write that it is okay for us to lose money, and we can afford to lose money, but we cannot afford to lose reputation. That is what Warren Buffett writes to his managers. Okay, so if the stock price goes down, usually the reputation of the company goes down. That's why people don't trust, so they will not put their money in their company, and the company falls. And what happens is that if they have debt, they have to sell their assets to recover those debt, so the company loses. And when they're struggling, bigger companies they swallow up these small companies. Okay, they take over this. Let's say there was an example, this NHPC, they swallowed up this NEPCO company. So like that. Okay, that's why the stock price movement is important in stock market. That's why it's very important for us. I'm saying this time and again, that's why it's very important for us to study the stock properly before investing. Okay, or else if somebody is saying, oh, it's a Reliance company, just invest blindly. You cannot. And if you invest, it may happen that just like Reliance Communications, Anil Company's company, it may fall and become bankrupt now. Thank you for watching, and like, subscribe, and share. See you in the next video.